Good morning, friends. Good morning, friends. Okay, let's start writing the summary. What area did we write the summary in the last class? Cost of capital. We are written till 30. Okay. Question number 32. Question number 32. Point number 1. Marginal cost of capital. Marginal cost of capital. Marginal cost of capital refers to the cost of. Marginal cost of capital refers to the cost of raising additional money. Cost of raising additional money. Cost of raising additional money. Full stop. The question has given information. The question has given information. Has given information on the amount to be raised. On the amount to be raised and its proportion. On the amount to be raised and its proportion. And its proportion. Full stop. We need to compute the cost of individual components of capital. Compute the cost of individual components of capital. Cost of individual components of capital and compute WMCC. Compute WMCC in the same manner. Compute WMCC in the same manner. In the same manner as that of WACC. Compute WMCC in the same manner as that of WACC. In the same manner as that of WACC. Question number 33. Point number 1. Money that can be spent. Money that can be spent with the available retained earnings equal to. Money that can be spent with the available retained earnings equal to. With the available retained earnings equal to. With the available retained earnings equal to. Available RE. Available retained earnings. Available retained earnings divided by weight of equity. Available retained earnings divided by weight of equity divided by weight of equity in the company's capital structure. Available retained earnings divided by weight of equity in the company's capital structure. Next, chapter 6. Leverages. Chapter 6, leverages. Question number 1. Question number 1. Format for calculation of leverages. Format for calculation of leverages. Format for calculation of leverages. Particulars amount. Sales less variable cost. Sales less variable cost. Contribution less fixed cost. Less fixed cost. EBIT less interest. EBT less tax, EAT, less preference dividend, EAES, less preference dividend, EAES, number of shares, earnings per share, number of shares and earnings per share. Next, below that, OL equal to contribution by EBIT, OL equal to contribution by EBIT, OR, percentage change in EBIT divided by percentage change in sales, percentage change in EBIT divided by percentage change in sales, percentage change in EBIT divided by percentage change in sales. FL equal to EBIT divided by EBT divided by EBT minus in brackets preference dividend divided by 1 minus tax rate, preference dividend divided by 1 minus tax rate, preference dividend divided by 1 minus tax rate, OR, percentage change in EPS divided by percentage change in EBIT, percentage change in EPS divided by percentage change in EBIT, EPS divided by percentage change in EBIT. CL equal to OL into FL, OR, contribution divided by EBT minus in brackets PD by 1 minus tax rate, preference dividend divided by 1 minus tax rate, OR, percentage change in EPS divided by percentage change in sales. Question number 2. The term net worth would mean equity shareholders funds. The term net worth would mean equity shareholders funds. Question number 3. ROI equal to EBIT divided by capital employed, in bracket debt plus equity. What is capital employed? In bracket EBIT divided by capital employed in bracket debt plus equity. ROE equal to EAES divided by amount of equity. EAES divided by amount of equity. Question number 4, 5, no special adjustment. 4, 5, no special adjustment. Question number 6. Point number 1. Two alternative levels of fixed cost levels of fixed costs, and two financial plans. Two financial plans are given in the question. Two financial plans are given in the question. Full stop. Combining them, we will get four scenarios. Combining them, we will get four scenarios. We'll get four scenarios, and leverages need to be computed. And leverages need to be computed for each scenario. Leverages need to be computed for each scenario. Did we do question 7? After that we had moved to? Okay, question 11. Question 11. Point number 1. Assume EBIT as X. Assume EBIT as X. Assume EBIT as X and get EBT as X minus interest cost. EBT as X minus interest cost. X minus interest cost. Next point. Use the formula of FL. Use the formula of FL and get EBIT. Use the formula of FL and get EBIT. Full stop. Get other information with OL. Get other information with OL. Get other information with OL. Okay, let's shift to question 7 now. If the combined leverage and the operating leverage of a company are 2.5 and 1.2, find the FL and PV ratio given the equity, dividend, interest payable, total fixed costs and sales. They have given certain information and asked us to compute two data points. What are the two things they have asked? Find the financial leverage and PV ratio. These are the two data points which we need to compute in the given question. Let's first put it in that format which we have. We'll fill some of them. Some of them may not be possible. So let's write that format. Particulars and amount. Particulars and amount. Start from sales. Do we have tax rates in the question? Is the tax rate given? No. So start from sales and write till EBT. Write that format from sales till EBT. Particulars and amount. Write the format from sales till EBT. Sales less variable cost, contribution less fixed cost, EBIT less interest, EBT. This is the format. We'll fill whatever is available and then get to see what is required. What data points you have in the question? Sales is how much?
10 lakhs.
Okay. Anything else? Fixed cost is how much? 50,000. Then interest is 1 lakh. Anything else? Sales is 10 lakhs. Fixed cost is 50,000. Interest is 1 lakh. Do we have anything else in the question? I think they have given some dividend which I don't need, of no use. There are two leverages given in the question. What they have given? Combined and operating leverage. Please use these two and tell me the FL. You have the link between CL, OL and FL. Link these three and tell me what is the FL. What is the formula? CL is equal to operating leverage into financial leverage. So do combined leverage equal to operating into financial, combined leverage is equal to operating into financial. 2.5 is equal to FL is 2 times. Any doubts on FL? How do I proceed beyond this? I need PV ratio. That's the other information asked in the question. How do we proceed beyond this? I want participation. Unless you participate, I cannot move forward. Not able to hear anything. Okay, so what will you do? You will assume EBIT as X. So we'll assume EBIT as X. Whatever I've done in question number 11, same adjustment we are going to do here. Now come down. Let us assume EBIT as X. Let us assume EBIT as X. Assume EBIT as X. EBT equal to let us assume EBIT as X. EBT equal to X minus 1 lakh. EBT equal to X minus 1 lakh. X divided by X minus 1 lakh. X divided by X minus 1 lakh is equal to 2 times X divided by X minus 1 lakh. What's the answer? Can you fill the entire table now? Everything else will fall into place. EBIT is 2 lakhs, contribution will become 250, variable cost balancing figure is 750. They are asked for 2 things in the question. What are the 2 things they've asked? That is done. Second one is PV ratio. PV ratio is what formula? Contribution by sales into 100. Complete that. PV ratio equal to contribution by sales into 100, 25%. Contribution by sales into 100. %25. Can we proceed? Go through question 8. Please go through the question. Okay, they've given information on the capital structure of the company. That is what is there in the balance sheet. Some information on profits, all those is there. They've asked us to do OLFL. Cover for the preference and equity, I'll give the formula in some time. Earnings yield, net fund flow, all these are related to formula, I'll explain. Basic thing is we need the OL and FL. Let's try to put it in the format which we have. So working note 1, leverages computation statement. Leverages computation statement. Start from sales right till EPS. Number of shares, everything is available. Start from sales and right till EPS, earnings per share. From sales till EPS. Write the format: sales less variable cost, contribution less fixed cost, till EPS. We'll see whatever information is available, not available, we'll try to calculate all of that. From sales till EPS. Please write the format from sales till EPS. Can we start now? The first information which is available in the question is earnings after tax 1,82,000. Earnings after taxes 1,82,000. Write that. Earnings after taxes 1,82,000. Next they mention operating expenses is 1.5 times of EBIT, but I need the EBIT, so I don't have all of them. So I'll try to compute them and then get the table. They've said operating expenses is 1.5 times of EBIT. We don't have any information on EBIT as of now. So let's somehow try to get that. Is the tax rate given in the question? Now please listen. Tax rate is 30%, which means EAT is 70% and EBT is 100%. If 70% is equal to 1,82,000, what is 30 and what is 100? Your after tax figure is 1,82,000. 30% is the tax rate. In short, a pre-tax amount, a post-tax amount can be converted into pre-tax by dividing it with 1 minus tax rate. If you divide by 1 minus tax rate, you will get the PBT. So divide and let me know what is PBT, earnings before tax. 2 lakh. Any doubts on this? 70% equal to 182, 100% equal to 260. Any doubts on this? Done? Now, if EBT is 260, there is some information on interest. Look at the balance sheet and tell me what will be the interest expense. 40,000, 10% debentures. So put 40,000 and get EBIT. EBIT is 3 lakhs. Any doubts on this? Now they mentioned operating expenses is what? 1.5 times of EBIT. EBIT is 3 lakh. Operating expenses is going to be 4,50,000. Now wait. That 4,50,000 has two parts, fixed cost, variable cost, because your expenses are, we need that categorization. Why they have mentioned including depreciation in brackets? What will be the reason for that? Depreciation is fixed, everything else will be taken as variable. So your operating expenses is 4,50,000. Of that, 90,000 is written here. Balance 360 is written at this place. Variable cost is 360 and fixed cost is 90,000. $1.5 times of EBIT. What they mentioned about preference dividend? 8% of 6,25,000. 50,000. 6,25,000. No, the value itself is 6,25,000. EAES is 1,32,000. Earnings available to equity shareholders is 132. Earnings available to equity shareholders 1,32,000. How many shares are there? 80,000. EPS is 1.65. Earnings per share is 1.65. Earnings per share is 1.65. Can you proceed? Any doubts on the EPS figure? Now let's get into whatever is asked in the question. What was the first thing they've asked? OAL and FL, I don't have much to explain. You get the numbers, that's all. I'll anyway do it on the board, but I'm not going to explain it. You get the answer directly. You know the formula, apply the formula, get to the answer. Can we proceed? Any doubts on this? Okay. Now some new formula is going to be introduced. Cover for the preference and equity share of dividends. You learn it in ratio analysis, but I'll just give the general formula. Coverage means when there's something called as an interest coverage, there's something called as a preference dividend coverage, expenses coverage. Now what does this mean is, there is a source for paying any item and what you are paying. For example, interest is going to be paid out of earnings before interest and taxes which a company earns. Your expenses are going to be paid out of the sales which a company generates. So there is an inflow and there is an outflow, and how much cushion are we having is what a coverage ratio indicates. Higher the coverage ratio, more is the cushion. My income for a month is 1 lakh, my expenses for a month is 40,000. Then I have a coverage of 2.5 times to meet my expenses. Even if my income falls sometimes, I can still be comfortable to meet the expenses, or even if expenses go up, still I'll be in a comfortable scenario because I have a 2.5 times. Sometimes you will have a 1.2 times coverage, which means it's a very tricky scenario. Even if income comes down a little, or expenses go up, you will not have adequate income to meet your expenses. So the base rule of a coverage ratio is, it indicates how comfortable are we in meeting any debt obligation, any preference obligation, any interest obligation, any equity shareholders obligation, any obligation you pay. The denominator is what you pay, the numerator is from where are you paying it. So that is what is called as a coverage ratio. For example, in this question, if I have to calculate interest coverage ratio, interest is the denominator, EBIT will be the numerator because interest is paid out of EBIT. Preference dividend coverage, preference dividend will be the denominator, EAT will be the numerator because preference dividend is paid out of EAT. They have also asked for equity dividend coverage. Equity dividend is the denominator and it is paid out of EAES because this is the money available to equity shareholders. So coverage ratio, the formula is source of payment divided by how much are we paying or what are we paying. That's the general rule. You will learn in detail in ratio analysis, but the general rule is source from where are we paying that amount and the denominator is what are we paying. Now write the formula. Preference dividend, cover for the preference and equity. Preference dividend coverage ratio equal to PD coverage equal to what's the denominator? Denominator will be preference dividend. Numerator is EAT. Basic rule is from where are you paying that amount. That's a very simple rule which we have. 1,82,000 3.64 times 3.64 times 182 divided by 50,000. Clear? Then equity dividend coverage. Equity dividend coverage. Equity dividend coverage. What will be the denominator? Equity dividend. Numerator EAES. Equity dividend, can you just calculate? It's not available in that table. They have given some numbers. 15% of 8 lakhs. 120. 1 point. Now there's not much coverage on equity dividend part because if earnings come down slightly also, you may not be in a position to pay the equity dividend. You may have to reduce the dividend. That 1.1 time is not a very good cover. Preference dividend guys are in a comfortable position. Their coverage is good, but PD coverage is not that great. Sorry, ED coverage is not that great for this company. Clear? Any doubts on this? Next they have asked earnings yield and price earning ratio. First let me give the formula for price earning ratio. Now write price earning ratio equal to PE ratio, that's the short form we normally use. Price earning ratio equal to PE ratio equal to, very simple, price earning ratio is equal to price by earnings. Price divided by earnings. Price earning ratio is equal to, the formula is price divided by earnings. Price divided by earnings. You just do one thing, price per share, earnings per share. Price per share and earnings per share. Price earning ratio is equal to price by earnings. All of this will get covered again in ratio analysis. There maybe I'll explain a little bit in detail. Price per share divided by earnings per share. What is the market price of the equity share? 20. What is the EPS which you have computed? 65. This will come in times. Divide and write it in times, the answer. Clear? Can we proceed? Next slide. Earnings yield equal to. Earnings yield equal to. I'm not explaining the logic here. I'll take it in ratio analysis chapter. Earnings yield equal to. Just reverse the formula. EPS by price. Earnings per share by price per share. Earnings yield equal to earnings per share by price per share. The only thing is the answer will be in percentage, so you'll have to multiply with 100. The final answer will be in percentages. Clear? The last one is net fund flow equal to now listen, what is net fund flow is profit is what the company generates, but it is not going to retain the entire amount with them. Some amount will go in the form of equity dividend, some amount will go in the form of preference dividend. So what is retained with them is technically like a fund flow. Listen, so what we will do is net fund flow is equal to EAT minus preference dividend minus equity dividend plus depreciation, because it's a non-cash item. Depreciation is not a cash item, it's a non-cash item, so you'll have to add back the depreciation. So in short, it is retained earnings plus depreciation. That is what is the final number for net fund flow. What you retain with yourself and add back depreciation, because depreciation is a non-cash item. So in short, this 132 you see, from there I have to deduct the equity dividend, whatever I am left over, that is technically retained earnings, and we are adding back depreciation. Anyway, we'll write the normal formula itself. Write PAT plus depreciation, PAT plus depreciation minus equity dividend minus preference dividend. PAT plus depreciation PAT plus depreciation minus equity dividend minus preference dividend. PAT plus depreciation minus equity dividend minus preference dividend. Done. Can you proceed? Let's do question number 10. We'll come back to 9 in some time. A firm has sales of 75 lakhs, variable cost of 42 lakhs, fixed cost of 6 lakhs, debt and equity, ROI, favorable FL, different leverages, sales drop to 50 lakhs. What will be the new EBIT? Okay, they've asked for leverages, so let's first get into that. We'll put it in the format. Is the tax rate given? No. So start from sales and do till EBIT. From sales till EBIT. Put it in the format. Sales till EBIT. Leverages computation statement. Sales till EBIT. leverages computation statement from sales till EBIT. Sorry, till EBT, till EBT. Till EBT. From sales till EBIT. What are the sales given? 75 lakhs. Variable cost is 42 lakhs. Fixed cost is interest is 4,05,000. EBT is 2295. $22,95,000. EBT is 22,95,000. Let's get the leverages. OL, FL and CL. Complete them. OL, FL and CL. Can we proceed? Next, what is the firm's ROI? Let's get that. ROI equal to, I have given the formula earlier. ROI equal to, what's the formula? EBIT divided by debt plus equity. EBIT by capital employed, which is debt plus equity. ROI equal to EBIT by capital employed. EBIT by capital employed EBIT by capital employed, which is 33, how much, sorry, 27 lakhs divided by 1 crore into 100 to get the answer in percentages. %. Okay, now listen. They've asked, does the firm have a favorable financial leverage? Now please listen. This now the company is earning an EBIT of 27 lakhs on an investment of 1 crore, which is debt of 50 lakhs and 45 lakhs and 55 lakhs. Now, what is favorable financial leverages? I am earning 27%, but to the debt guys I am paying what rate? Only 9%. So we are earning 27% on 1 crore, but paying only 9%. So the surplus which is left over will go to equity shareholders, guys. Now what is going to be the return on equity is It's not balance 18%. It's a concept of weighted average, and equity guys will earn 41%. It's a weight, the 27 is a weighted average of 41% and 9%. The 27% which you see as ROI, it's technically a weighted average of 41% of return on equity and 9% of cost of debt. So whenever a company pays anything lower than ROI, to debt guys, it is a favorable scenario for equity shareholders. If that paid 27%, then equity guys will also get 27. It's not 27 minus 27 is 0. If you pay 27% to debt guys, equity guys will also get 27%, because weighted average of 27 and 27 will become the final 27%. So the concept is, whenever a company earns X return and it pays X minus something to debt guys, the surplus will get added to the equity shareholders guys. So technically I paid only 9% to them. So to equity guys, I'll give a return of 41%. Now write in the center of the page financial leverage, and split it into two. Favorable, unfavorable. Financial leverage, split it into two. Favorable, unfavorable. Favorable, put arrow mark down. Put arrow mark down. ROI greater than interest rate. ROI greater than interest rate. That's a favorable scenario. ROI greater than interest rate. Unfavorable, ROI less than interest rate. ROI greater than interest rate. ROI less than interest rate. Greater is favorable, less is unfavorable. Clear? Now write in this question, the firm has favorable financial leverage. The firm has favorable financial leverage. Has favorable financial leverage as ROI of 27%. As ROI of 27%. Of 27% is greater than cost of debt of 9%. Is greater than cost of debt of 9%. Next they are asking sales drops, what is the new EBIT? Listen, I can either do it in this tabular format and get to the EBIT, which I wouldn't want in an exam scenario. So I would try to link the leverages and get sales, and EBIT is linked with which leverage? Operating leverage. So based on that we are going to get the EBIT. Now calculation of new EBIT. Calculation of new EBIT. Point number 1, existing sales equal to how much? 75 lakhs. 75 lakhs. Point number 2, revised sales equal to how much? 50 lakhs. Point number 3, percentage fall in sales. Percentage fall in sales. Tell me how much has been the percentage drop in sales. It's a drop of 25 lakhs on a base of 75 lakhs. Drop is 25 lakhs on a base of 75 lakhs. In short, the sale drop is 1 by 3, 33.3333%. It's a drop of 1 by 3. Any doubts on this? Next point. OL is 1.2222 times. Let it be 4 decimals. OL is 1.2222 times. 1.2222 times. Full stop. OL indicates that 1% drop in sale, 1% drop in sale would lead to 1% drop in sale would lead to 1.22 percentage 1.22% drop in EBIT. Percentage drop in EBIT. Full stop. For the current scenario, the drop in EBIT, for the current scenario, the drop in EBIT would be, multiply these two. It will be 40.7407%. Let it be 4 decimals, otherwise allow rounding of issues. 40.7407%. 33.3333 into 1.2222. That's what is the link. 33.3333 into 1.2222. So you will have a drop of 40.7407%. Any doubts on this? Any doubts on 40.7407%? Next point, new EBIT equal to 27 lakhs minus this number. 27 lakhs minus this. You will get it as 16 lakhs something. The answer is 16 lakhs. Balances because of rounding of issues. It is broadly 16 lakhs. You may get 16 lakhs something. You write it as 16 lakhs. You will be getting it, I think, 16 lakh 21. You can leave it as 16 lakhs. Any doubts on this? That I could have easily done it through a statement, but in exam my expectation would be that you link it and write. That will be the expectation. We can quickly check the calculation here. Sales would have become 50 lakhs. If sales become 2/3, variable cost will also become 2/3, 28 lakhs. Contribution is 22. Fixed cost will continue as 6 lakhs. And EBIT would have been 16 lakhs. That's the easier way of completing the problem. But yeah, in exam, the linkages needs to be developed. Any doubts on this? Clear? Can you proceed? Let's come to question number 9. Go through the question. Now coming to this question, there is something called as that segmentation analysis, which I'll take you through in some time. The second part is asking for OL given that combined leverage is 3 times. If I start from the question, I have net sales, I have EBIT. In between, I don't know what is variable cost, contribution, all of that is not there. EBIT is available. This information can help me in calculating the denominator called as EBT minus preference dividend part. So calculate the OL given that the combined leverage is 3 times. What we are going to do is first we'll calculate FL, because OL can't be computed directly in this question. You will compute FL, and OL into FL is equal to CL. That is where that they have given the combined leverage in the question. Working note 1, calculation of operating leverage. Calculation of operating leverage. Operating leverage. FL equal to EBIT divided by EBT minus PD divided by 1 minus tax rate. EBT minus PD divided by 1 minus tax rate. All the numbers are readily available. $360 lakhs is the EBIT. EBIT is 360 lakhs or 3.6 crores, whatever way you want to do it. 360 lakhs divided by 360 minus 90, that is you subtract interest. 360 minus 90 minus 26 divided by 0.6. 2 decimal answer. 360 divided by 270 minus 26 divided by 0.6. $1.59 and then get the OL. OL is 3 divided by 1.59 or OL is 1. Okay, take it. 3 divided by 1.59. 3 divided by 1.59. Clear? Can you proceed? Now comes the ROE analysis. Calculate the ROE for the company and indicates its segment due to the presence of preference share capital and borrowing. Now they have asked something called as a segmentation analysis. So for that I need certain information. Let's do that. Point number 1, ROE equal to what was the formula for ROE? It was not EBIT. EAES divided by amount of equity. EAES divided by amount of equity. What you do is, okay, I should have ideally done that. Let me do leave some 4-5 lines. particulars and amount. We should have ideally done that earlier itself. Particulars and amount. From EBIT till EAS, write everything. EBIT less interest, EBT less tax, EAT less preference dividend, EAES. Till EAES, fill the format. From EBIT till EAES. It's not for leverages calculation, that's already done. I am using it for getting the segmentation analysis. So from EBIT till EAES. From EBIT till EAES. From EBIT till EAES. I've done it in lakhs. Clear? Any doubts on this calculation? Now write equal to 136. How much the amount of equity? 10 crores, so 1000 lakhs. 136 divided by 1000. %13.6%. Now, this 13.6% will be because of few segments. So, that's what we are going to analyze now. Next, point number 2, ROI. ROI. What is the formula for ROI? EBIT divided by. Now, listen, it's going to be debt plus equity plus preference. There's a preference also. Wait for some time. Debt plus equity plus preference. My ROI has two names, pre-tax ROI, post-tax ROI. ROI doesn't have two names. Return on equity will be only one return on equity, because there's nothing like a pre-tax return on equity because after the taxation only they are going to get that money. In case of return on investment, we can have two types of return on investment: pre-tax return on investment, post-tax return on investment. Wherever taxes are given, we normally work with post-tax ROI, not with the pre-tax ROI. In one problem, we had done that 27% because tax was not there. If tax was there in that question, we would have done post-tax ROI, and return on equity also would have been post-deducting the taxes in the question. Those information was not available. So, here it is going to become EBIT into 1 minus tax, EBIT into 1 minus tax divided by debt plus equity plus preference. EBIT into 1 minus tax divided by debt plus equity plus preference. EBIT into 1 minus tax divided by debt plus equity plus preference. EBIT is how much? 360 into 1 minus 0.4 divided by debt is how much? 600 plus 1000 plus 200. How much? 600 plus 1000 plus 200, 12%. Now, ideally what should happen is ROE is 13.6%, ROI is 12%. That is what we have computed. Ideally, my return on investment and return on equity should be same. If it is higher or lower, it means the other people are not getting 12%. Equity guys are balancing figure. If you pay more to debt, equity guys will lose. If you pay less to debt, that example 9% and 41%. So when we earn 27 and we pay only 9, we are giving that excess to the equity shareholders. Now the requirement of this question is calculate the ROI and indicate its segments due to the presence of preference share capital and borrowing. Now listen for some time. Form of capital. There are three forms of capital which are there in this question. What are they? Equity, debt, preference. Amount. How much is the amount of equity? 1000, 600, 200. I'm doing the entire problem in lakhs. Now this is amount to be paid. What I should ideally pay them is 12%. What I should ideally pay them is 12% because that is what the company has been earning. Amount actually paid. We have actually paid 136 to equity guys. Are they eligible to get 136? Preference dividend. How much is the preference dividend paid? 26. How much is the interest paid? 90. Now listen. 90 is not the expense of the company. 90 is what the person receives. But the real expense of the company is 90 into 0.6. What is 0.6 is after tax interest. Interest is a tax deductible expense. When we did cost of debt, the formula used to be interest into 1 minus tax rate. Surplus slash shortfall. To the debt guys, you have paid only 54 whereas you should have paid them 72. To the preference, you have paid 26 whereas you should have paid only 24. Where will this 18 and 2 go? This will go to the equity guys. They will take away the surplus or the shortfall. If you pay less, they will take it. If you pay more, they will have to bear the consequences of that. That is what the concept is. I have earned 12%. It's my wish whether I pay 12% to preference and debentures. To preference, instead of paying 12, you have paid 13% more. Debentures, you have not paid 15%, you have paid only 9%. Because after tax interest. So you have paid only 9%. That surplus left over will go to equity guys. So this 18 and 2, whatever surplus you see, that has gone to equity guys in the form of 16 lakhs. Any doubts on this? Any doubts on this? There is a surplus of 18 lakhs. Sorry, there is a shortfall of 18 lakhs to debt guys which has gone to equity. There is an excess which is a loss for the equity. So there are two items of gain. Sorry, just a minute. This is a loss for equity shareholders. This 2 lakh is a loss for equity shareholder. This is a gain for equity shareholders. Clear? Any doubts in this? Now, this 136 which I have paid. I paid 136 or in bracket 13.6% has 3 components. 120. What I am eligible to get. 120 is what the company has been paying. 18 extra. Why is this 18 extra coming? Because of debt guys. Minus 2. Why is 2 deducted? Because of preference guys. So 12% is what the company has been earning. Extra 1.8%. 18 on 1000. Extra 1.8% because debt guys are saying we are okay with lower amount, you take away that amount. So we are paying 1.8% extra because of debt guys, and preference guys are taking away 0.2% from me. 2 on 1000 they are taking away 0.2%. So equity guys are earning 13.6%, whereas the company is earning only 12%, because of two reasons. Extra 1.8 percentage due to debenture holders and shortfall of 0.2 percentage due to preference shareholders. Clear? Any doubts on this? Now wait for just a minute. Now we have done this calculation. If instead of paying 9 percentage to them, what was the tax rate in this question? 40%. So 12 divided by 0.6. I should have ideally paid interest at the rate of 20 percentage. That is what an ideal interest payout, because the company has been earning 12 percentage. If that had happened, this would have been 120. Just a minute. How much is the debenture holders? 6 crores. Tax rate is? 40%. Okay. And preference also I should have paid only 12 percentage. I shouldn't have paid more. If this has happened, equity guys would have got their 120 only. They are eligible to get only 120. They will get more than 120 the moment you change interest. The moment you change preference, they will get more than 120, less than 120. They are the last person. So you pay more, they lose. You pay less, they gain. Clear? Any doubts on this? So the segmentation analysis is, I have three forms of capital, which is 1800. This 1800 I should pay 216. I have paid 216. I should have paid 216. I have paid 216, but I played in between because I paid less to debenture holders, that is gained by equity shareholders. I have paid more to preference shareholders, that is lost by equity shareholders. So the segment is 13.6 is because of three reasons: 12 percentage company earning, extra 1.8 percentage due to debenture holders, and a shortfall of 0.2 percentage due to preference shareholders. Clear? Any doubts on this? Do this table and show the segmentation.